the next event is on private debt. It's a private debt panel. We have Danny Kattan. He is running this panel. Danny is with Pia Residential, and I am going to turn it over to Danny so that he can moderate.
Thank you, Michael. Thanks everybody for putting this panel together. Well, first I'd like to thank all the first responders who are out there just making this country work, and to everybody who's joined us and giving us their precious time to hear us talk about private lending. So with me, I have Camilo Nino from LB, Rafael Serrano, Elena Gertsberg, and I have Robert Jafek, four distinguished panelists that have a lot of experience in this arena. And so you have the bios of each one of us in front of you. I'm not going to go into a lot of detail. I'm just going to ask everybody just to give us a minute. So Elena, ladies first, please.
Hello, I'm Elena Gertsberg. Hello, everyone. I run family office, which is incorporated in Singapore, and it exists since 2011, so it's quite a round date soon. We are focused on private debt, and we like senior secured private debt, first to second lien, and mostly we like, if we go for second lien, then it should be a sustainable bank, which will take a massive part in that loan. We started to invest for funds, and finally, we ended up with doing direct lending. We like real estate. We're quite opportunistic, to be honest. But there are industries we don't understand and we don't want to understand because they're complicated, like transportation, like aircraft business. And when we meet some opportunity like that, then we handle it to other family office around the community, or investments with a partner who does understand the business deeper than we do. So that's how it works in our case. Geographically, we are focused on Western Europe and Asia because we like to receive double-digit return.
Elena, I think I'm not hearing you well. I'm not sure if everybody's having the same issue or just me, but I think we're having some sort of sound problem.
Sure, and better now?
Oh, much better now, yes.
It was my finger on the microphone. Sorry. Yeah, so we focus geographically on Western Europe and Asia because there are so many lucrative opportunities in that areas. And we started to look at the United States because the approach is different. So you don't need to know people to get deals. Like they come to us organically. I just go to a conference and then it works favorably. I mean, deals are coming. So this is what brought me here to this conference.
Perfect. So just to understand, you're an investor in debt.
In private debt.
You don't originate. Okay. Camilo, you are an originator, right? So tell us a little bit about yourself.
Sure. My name is Camilo Nino. Thank you for having us, Michael. Nice to see you, Danny, again. Our company is called Linkbest Capital. It's a co-investment platform focused on alternative investments. And in those alternative investments, one of our main products is bridge loans. So we are originators of bridge loans. We do the servicing or the management of the bridge loans, but we are also co-investors in our own deals. So we are putting a lot of skin on the game in the deals that we do. Basically, we create the lending platform to give investors a fixed income opportunity, but getting a higher yields than the market was offering them. So we have a safe product, but gives between 8 to 9.5% for the investor, which is much better, and not getting a higher risk than any other product that they can get. And doing the lending part, we end up doing commercial property acquisitions and multifamily development because we got good relationships and good partnerships with some of the borrowers and sponsors that we work with. And when we like those partners or sponsors, we end up investing equity and being the main equity partners in those development deals. So we have both roles, the lending side and the real estate and development side.
Awesome. So to summarize, you lend money and once in a while you also take part on the LP side.
Exactly.
Rafael, long time, my friend. Nice to see you. Tell us a little bit about yourself.
Yes, certainly. It's been a while. Thank you, Danny. And ladies and gentlemen, thank you. Camilo, nice to see you again.
Nice to see you, Raf.
So Safe Harbor Equity is a private equity firm, has a very specific focus, and our focus is the purchase and acquisition of distressed debt. But we do not only buy debt instruments, we will very occasionally originate debt, but primarily we are a purchaser of debt. And we buy debt from all different sources, all types of lenders across the spectrum. But that is our primary focus. We do also do other types of investing outside of our fund format, but that is primarily fortunate. We're now in our 16th year of business and have very strong relationships in the community with a lot of lenders and a lot of operators, and fortunate and feel good about it to be here.
Sorry. So you do not originate debt. Unlike Camilo, you buy the distressed debt. Good.
That is correct. We modify it and make it reperform and restructure debt. But yes, we don't. It's not often that we do that.
So Elena invests in people like Camilo that originates debt, and once in a while that debt doesn't work well, and you might be able to buy that debt, not from Camilo, I hope from the banks. Okay. Robert, my friend.
That either makes me the odd man out because you got everybody else all hooked up, or I'm the guy that does it all. And so we do. We're a hard money lender. A bunch of you have seen this slide before. We're a hard money lender. We originate, we underwrite, we service, and then we worry about it as a portfolio because it needs to be worried about as a portfolio. You don't want to originate all in one place or all in one state or have concentrations and those sorts of things. So people come to us for a fund, and that's what we do. It's hard money lending. We are concentrated in Arizona, Colorado, Texas, a little bit of Utah, a little bit in North Carolina, and then you can see our results off to the right. Everybody wants to jump right to that one. We used to put this slide up and we were outperforming the S&P for a while, but the S&P just seems to have nicked us. The blue line just seems to. But there's a number of people on here that are investors in our fund, which we appreciate. We have a number of people who are frenemies, competitors, that sort of thing. There's plenty in this space for all of us. So we talk to a number of those. We do it a little different. In each of those, we originate our own stuff. We're not just buying. We underwrite our own stuff. I think a lot of people do a good job underwriting. We worry about it as a portfolio. We're not selling it. We're keeping our own stuff, and then we service it. And we think the servicing is really important to keeping it all together.
Great. By the way, there's no such thing as competition in this flyer group. It's co-opetition. We compete and cooperate.
That's the idea.
Okay.
And that's really been my experience as well. So I don't want to. Yeah.
So Danny Kattan, I started buying single families in 2009. We created a portfolio about 400 single families, 400 small multifamilies. We ended up creating one of the vertical integrated platforms on the single family side. Got out of the single family trade in 2018. We sold most of our portfolio to Cerberus. Now we open up our platform to investors who are basically investing with us and buying multifamily. We got a couple of them, and also in addition to that, we're probably going to start doing some hard money lending because we get some once in a while get phone calls from friends. It's like, hey, you know what, can you guys lend us money on this? And so it became more than just a onesie twosie, and now it's becoming more sort of traction. Our model, unlike Camilo, we're going to be a fund. we're just gonna give people a 7% on their money and that's it, no fees, nothing, no upside, no downside. So I mean, the downside that obviously a loan has. But having said that, I think that we are here complementing each other. Most important, we have about 160 participants who are probably gonna be paying a lot of attention to what we say. So I'm gonna start from Rafael, because Rafael, you're in the sort of non-performing distressed debt market. And apart from office buildings and hotels and what it's natural and retail strip centers, which probably are going to be trading a lot of non-performing notes, what have you seen on the multifamily side, on the residential side? Because I mean, I called yesterday a friend of mine who works on a big lender, Freddie Fannie lender, yesterday, and I'm like, tell me, what do you have in your book that is non-performing? It's like, out of the whatever $1 billion, they have only one property that is non-performing. So on the residential side, what's coming down the pipeline? What are you seeing on that side?
Well, let me just clarify something. Safe Harbor Equity specifically focuses on commercial real estate, but I am the majority owner of a loan sub-servicing company, and we service loans for Freddie and Fannie because I've been in this business for 15 years. So I do have a lot of visibility into the secondary. What I can tell you about the residential side, and there's two things are different.
Residential side, I'm talking multifamily, Freddie Fannie loans, way up there, right?
Oh, I see. Okay, I'm sorry. I thought you meant. So you're talking really commercial, not single family residential.
Yes.
I'm not seeing a lot of multifamily, to be honest with you. I think that I mean, there's some. We actually just picked up a loan on 103 units of multifamily in Little Havana, but there's not an abundance of it, and there's a few things that are coming up that weren't around before going on, but it is not at the level that one would have expected given the nature of the financial, given the nature of what happened, the crisis that we're going through, and a lot of people obviously, holding back rent payments and things of that nature. So I'm actually surprised, but it's a good thing, right? I guess people are paying their rent to a great extent. Again, I'm seeing a little bit more than what I saw before. So it's out there, but it's nothing extraordinary.
Okay. I guess the biggest question that people have is COVID. What happened before COVID? What happened after COVID? And when I ask you guys to send me questions, a lot of the questions that you guys send, it says, would like to talk more about the sort of how COVID affected us and how COVID affected our business and the asset classes. So Camilo, why don't you tell us a little bit, because you're on both sides. You're on the lending side and also on the principal side. What have you seen? What is the biggest effect, that positive and negative, that COVID has had in your industry? And what are you seeing coming forward?
Sure. In the lending side, I didn't see that much impact or bad impact on our loan portfolio, and also on the overall market. I agree with Ralph. Everybody was expecting a lot of discounts in non-performing loans coming to the market and huge opportunities to buy distressed assets or non-performing loans at a big discounts, and that didn't happen, has not happened, and I don't know if it's going to happen. Nobody knows, but it seems like things are stabilizing, so I don't think so. We have a couple of loans related to services or to hotels that have some impact, but overall, because we do maximum 60% loan to value, our average is 50% loan to value, people tend to protect their properties and they tend to pay. We work with the borrowers in some cases and did some deferrals and some adjustments, but overall our portfolio performed pretty well, which was also a really good surprise for us, because you always think that your product is really good. You always think that everything is going to be okay, but you never know until something like this happens. So it was a reality check, and until now, everything is working pretty well. Hopefully, we don't need Ralph to sell him a couple of loans, but you never know. But because we try to work with our investors, like the yield and the stability of the yield, not the problems and the issues. And we are not here to take properties back or nothing like that. We are here to lend money and redeploy the capital when we get payoff. That is in the lending side. we have a small portfolio. We had 14 properties, commercial properties, triple net. Actually, we sold 4 of them last year at a really good prices. So a lot of people was looking those kind of assets I think, for security purposes. But all our tenants continue to pay. We didn't have any tenant. We have big tenants, national tenants, but none of the tenants stopped paying us. So at least for us, worked pretty well. Most of them are in defensive industry, so they continue to work during the pandemic. And in the multifamily development, we did have some issues and delays, basically because of the construction lending. The banks stopped lending and stopped taking decisions. So we were supposed to close a couple of loans in February, in March, in June, and it took us 6 months. The projects got delayed 6 months, but we have pretty strong partners and pretty good developers, and they end up getting the construction loans and moving the project forward. But it was easily 6 months that we had to delay the projects and stop the projects because we weren't able to secure the construction loans. Even having, we weren't ready to close in February last year, and the banks, because of March and they delayed the process, and they end up saying that they want to wait a couple of months. And as you know, when you have a project where you have permits, you have investors, you cannot wait forever. So we end up moving with different banks, and right now all of the projects are developing, but we did have an impact of easy 6 months of delays because of the COVID situation.
Yeah. Rob, so, I mean, I guess everybody's more or less going to have the same situation with COVID. What has come out of left field that you wished you had prepared for before COVID? And what will COVID make you underwrite going into the future? Meaning, what lessons did we learn that you're going to implement in your standard operating procedure so you are not caught off guard next time? If there's a next time, will it be a next time? That question was, nobody ever thought about pandemic. Now it's in our psychic, and then we will underwrite to a pandemic.
Yeah, there's always something new. I mean, I was thinking, last time we were talking about opportunity. If we were to roll it back 2 years, opportunity zone, and those sorts of things. So what have we changed? We have a much deeper respect now for the states that are active in. So New Jersey, all the states that have really slowed foreclosure, gummed up the positions, gotten quote unquote active in the resolutions, has not been good. It's not been good for us as we try to, we will originate probably around, over 1,000 this year. We'll get back, our default rate will be around 1%. So we'll get back a dozen or so, somewhere in there. That handful that we've got, the ones take forever in New Jersey and in New Orleans. And, the presenters before were talking about really getting excited about New Mexico. You want to take a look, you want to take a good hard look at the government there before you jump into that one. So I think that's, it's not necessarily that there's been something super new, more it's just a reminder, hey, this is the way it works, and it continues to work that way.
But Elena, question to you as an investor, what are you looking for? What are you staying away from, regardless of pricing? What is a red flag, and what makes you invest in a fund or a company?
Well, I can say we came not ready to the recession. Actually, I started to go to different conferences in Zurich, in Davos, and even in Beverly Hills, LA, with the topic how to get ready for recession, how to buy assets during recession, and what kind of assets. So actually, we collected information, statistical information about family offices and their approach to portfolio management. And we found out that 42%, including us, were restructuring portfolios because everyone was feeling like recession is coming. So generally, family office community was kind of ready, like 50% ready, we can say. So investments under recession, they are a little bit different. First of all, COVID influenced our mind. We were scared to invest because we didn't know what to expect. Under normal recession, you understand how it goes. So you start to buy when it's 8 months of the recession, and when market is below 40%, slow down 40% and lower, and then you start to buy like weather, yeah, more and more invest into assets. But COVID was kind of unpredictable situation. We didn't know when to join the market, when to start to invest, where is the point? So we missed, honestly, several good opportunities, like copper mining company in Arizona. We missed that one. And look where commodities prices right now. Also, we were cautious about real estate investments because some projects were coming our way. And we were thinking, how high is LTV? Is it high enough for us? Do we feel comfortable with the strategy? Because it was feeling like no one has a strategy in COVID. So at the very beginning, from February to March, we didn't invest at all. We were watching the market. And then good opportunities started to come to us, like safe opportunities. For example, private debt to Amazon. What can happen with Amazon? Probably nothing. So we went to that opportunity. Later on, it was also real estate investment, but it was LTV 50%. It's possible to sell it anyways on a different market cycle, but it's possible. So join that opportunity. So primarily, we want to understand the team. We want to do background check on owners of that asset, which we are going to kind of acquire, maybe not, or to acquire and sell it to Rafael. We don't know how it's gonna be, but in general, we really want to understand the business. Before, we haven't been so cautious about the deal. Now we do background check of everything, and also we look at other investors. We like investment opportunities. More investors better than just one investor, and we don't want to be that one. So primarily that is it.
Okay, guys.
Thank you for the question.
No, thank you. So I'm gonna take this a little bit on the side, and so I've been doing a lot of research of the impact of technology in real estate, right? Way before COVID, right? And when I was telling people that, I'm a shying away from offices because I think that eventual, holographic teleconferencing, which by the way it exists, will start to replace office or interaction. People are kind of laughing, right? And then we saw Zoom, how in 3 weeks, schools went from 0 to 100% Zoom meetings, right? And we saw how technology is changing the world. By the way, I'm gonna put a link in the chat here about what I do. But the question to you guys is, what are you seeing and what you're afraid of? What sort of asset classes you're not touching because you think they're gonna change? Forget about COVID in the future, right? I mean, what is retail doing? What is hotels doing? What are offices doing? And what sort of, asset class you will not touch, period? And what asset class you think that it's undervalued and you going all in on it? Anybody wants to take that question? Rafael, you're the non-performing note buyer. So how much of a discount you need to buy a hotel note for example, or talk about what notes you will not buy?
Well, that's an interesting question. I should have pointed at something out earlier, and I think it's worth saying. In all of 2019, we looked at about 400 million worth of bad loans. 2020, we looked at 2.1 billion. Okay. So there is a lot of bad debt. You're just not seeing it because unless you're in that business, if you're not in the secondary and you don't trade in that business, you're not going to see it very likely. It's just a very niche market, but it's very important that people understand that it is there. What's happening, and most of that stuff has just been extended. It's under deferment agreements, right? When in March obviously of last year of the crisis, came out and allowed lenders, government subsidized lenders, to extend these under deferral agreements, all of the bad debt. So it doesn't mean that it's not there. You're just not seeing it come to market yet. In the single family residential space, there are 2.7 million residential loans under a deferment agreement. As soon as the moratoriums end, there is going to be something that's going to happen. I would speculate, but there is a lot going on. The directive from the Fed, I believe it was April of last year, allowed lenders to defer payments and not impact the tier one capital, right? So by not impacting the tier one capital, the lenders don't have to take a hit on the balance sheet, but they're going to take a hit on the income statement, right? Because if you're not collecting interest for a year, what happens? So I just think that it's relevant to say that, because I think that while you may not be seeing it, I wouldn't be surprised if down the line. Hold on one second. Let me just.
But you haven't answered my question. Which asset class you really don't like?
Listen, I like everything. There's no such thing as a bad deal, just a bad price. We just bought a hotel on Ocean Drive. We bought the Tides loan. The loan on the Tides Hotel is my understanding. My team, we picked that up. And again, it's not about a bad deal. It's about a bad price. I will say this. For me, I think it's more about geographies are the things that I'm more concerned. I think that's what we tend to stay away from, are geographies where there is not a lot of velocity in the market space. So for example, an asset in New York, even New York, where right now is going through a significant difficulty, is still New York, right? Georgia, Atlanta, Georgia is still obviously a primary market. Miami, Tampa, Dallas, Austin. We typically stay away. I would not be buying loans typically in Central Florida, in the middle of Iowa, just because I don't, A, know those markets, but B, if they're not high velocity markets and we did have to take an asset back and sell it, our concern would be that there is a market to sell that asset. So for us, it's not about the asset class so much as it is about the geography. And then of course, the price, right? And the value proposition on the price.
Okay, so who wants to take the answer next? Camilo, which asset class you think it's going to be underperforming going forward, regardless of COVID?
Underperforming big malls, big retail, which has been underperforming before COVID, but it is getting worse because of COVID. Some office buildings, and I agree with Raf. If it's an office building in Brickell, Miami, maybe has a difficult time for a couple of months, but at the end it's going to be okay. But in mid markets or in small markets, I will not do office. Hotels for now are difficult, but I think they're going to come back, maybe with technology
Let me ask you a
changes.
question. With everything that we know so far, if I tell you to give a loan on a gas station, a long-term loan on a gas station, will you do it?
The answer is yes, but I will need to understand what is the potential development of that site, because I don't think that first, our loans are 2-year loans, short-term loans, bridge loans by nature. So for 2 years, I don't think we are going to have a huge change, but long-term, I don't like that specific business. I think it's threatened, as we all know, by electric cars and a lot of changes in different clean energies. But for us, it's the asset. And if that asset can be clean and then redeveloped into multifamily, why not? We can do it. And also in the equity side, that's why we focus on multifamily, because even with COVID, if you have a good product in a good location at the right price, multifamily is going to continue to work, either to sell the product when it's stabilized or just to keep it for the long run.
Rob, any asset classes you don't like?
Well, looking at, single family residential, so I'm not really the guy to talk to on, office or retail or those sorts of things. We do not like, fundamentally, we do not like New Jersey, California, New York. We think that, you've got an eroding tax base, you got some problems there. I agree with Rafael that it's all about the price. I would,
but let me interrupt you here. I don't want to get political. So
no, it's not political.
No.
It's reality.
This is reality, and this is about green, right? So when counties, states, or cities create a a lot of friction around evictions and all these things, they basically are asking the lenders to create a higher price for those types of states, right? Like,
You
well,
bet. Absolutely. The risk goes up, the price has to go up.
right. So they're doing a disservice in the way to their base. Right. Right now, everybody's who's buying a multifamily saying, okay, I need to take a discount for COVID, right? Or whatever it is, right?
Yeah.
And so it really doesn't make sense to protect a lot of people when at the end, you know, the prices for those people are going to go up. I mean, there has to be a better way. But without getting political, what you're saying is now people who are lending are starting to look more at the underlying situations on every state. Right?
Absolutely. And I think, you know, if you take the politics out, you know, Florida has an interesting, you know, y'all are in Florida, the Castle State doctrine is creates some issues.
Can you explain
not
that
about-
for the people? Can you explain that for people who are listening? The castles. I mean, is it the White Castle State doctrine and it has something to do with hamburgers? No, right?
The Castle State doctrine makes it very difficult to evict someone from their primary residence. So, but it's not necessarily that's, you know, we can argue about whether that's a good thing or a bad thing, but it's a stable thing. Everybody knows if you're going into Florida, that's how it works. So there's stability in the impact, and the problem is some of the transitions.
Okay. Now, I want to call attention to something. So, I was gonna do a hard money loan on a person that basically, great entrepreneur. The docs were not really lining up for the banks, and you know he couldn't come up with a full doc.
Yep.
You know,
pretty
we're
normal.
a 9+2. You know, and then he found out a no ratio loan, right? So you know, I start seeing now more and more. There's no ratio loans, kind of no doc loans. You know, back to the old days of the no income, no asset
Ninja loans.
right?
Ninja.
Being you know, worked in Countrywide when it's, you know, when I was there and I saw the FBI coming people to you know, to arrest mortgage brokers. Is that too much money chasing yield is gonna create some sort of like erosion on the quality of the paper? Are you guys starting to see that? Are you guys starting to see more aggressiveness on the part of certain lenders? You know, I've seen 100% loan to cost loans being made to fix some flippers that have done too, right? Are you guys seeing a danger right now out in the market?
We're definitely seeing it. They're always going to be there. You know, when you've got the private lenders, that sort of stuff, but it's not significant. One of the games that we're seeing played now is the teaser rate, right? We'll lend you money at 7.99% or whatever, but they're just jacking up the fees on the other side. So you'll always see that. There is probably a little extra fluff going on in the market right now, Danny, in the markets we see.
But I do agree that a lot of liquidity and the low interest rate environment and everybody chasing for yield is making, first, a lot of people is getting into the field. Second, a lot of people from California, New York, New Jersey coming, for example, to markets like Florida and Texas because they want to get geographic diversification. So here in Florida, they are being more aggressive, and that's a lot of competition. And that will create an issue down the road. A lot of opportunities for Ralph, because I think that we as private lenders cannot be as aggressive in the LTVs as banks because of the cost of capital. And if you want to compete in LTVs with banks, either you have a really low cost of capital or you have to change the whole risk profile of your offering. So I think that for us, for example, that we don't go up in loan to value, we have to rely on the relationships and really developing long-term relationships with the sponsors and borrowers that we like and that we can do more than one transaction. That even though they can get maybe 1 point lower the interest rate or a little bit more of LTV, they rather work with people that they already know and that know that we are going to fulfill what we offer. And that we are for the long run in this business, not only chasing yield for now and when the yield or the interest rate goes up, they move to a different product or a different investment.
I think what you said is important. Is this is a hard money loan. People just look at it as a rate and term, and they don't look at the other services that you guys provide, which is advisory when things go wrong, right? The ability to talk to the owner of the loan, right? I mean, I had a person who borrowed from me. I gave him a very good loan, and then he got caught with permits issues, and then he had to extend for a year. And for me as a person who's been in the business, I understand. And he called me up and the whole thing. So that, as Rob correctly said, servicing is very important. It creates a lot of value, right? And I think that the value is more than the rate and the term. So we have 150 people in the audience, and we have no questions. I encourage you guys to ask questions. I'm just going to keep on going through this. Black Swan event. So COVID was something that came out of the blue. And I think that, back in March last year, people thought that, the market was going to collapse. We were doing sort of back of the envelope of how many people were not going to pay the rent. But the government stepped in and said, hey, you know what? If you cannot pay your mortgage, it's okay. And they created this sort of back end to prop the market. What are the Black Swan events you guys have in the back of your mind that it's bugging you? I mean, Rafael, tell me about, what doesn't allow you to sleep? What can go wrong in your side?
Well, a lot of things don't let me sleep, but this isn't one of them. I think the political risk, the political climate, what could potentially happen with the new administration, and I guess it would be fair to say legislative risk, right? We're very fortunate that, and I think that Rob touched on this earlier, maybe in a kind of bottom line is that he's staying away from venues that he perceives are challenging to enforce his contract right of law. And is that right, Rob? Did I characterize that correctly?
Absolutely. Yeah, that's good.
And I certainly appreciate that. And I think that's one of the things that I think is a fundamental risk of anything when you are, we all just election and how polarized we are, and not to make this a political conversation by any means, but certainly that certainly inures to where the administration goes and where legislation goes, and so on and so forth, and that legislative risk is something that I think can impact, especially in my business, because where most of the panelists are hard money lenders and they just originate and then they collect, we really buy bad loans the majority of our time. When we're not able to restructure, we obviously have to enforce the contract right of law. So that's a huge part of what we do. And so we're very immersed in that. And so that's something that I think that we're mindful of. There's pros and cons, though. I can tell you that, like, California is a non-judicial foreclosure, so there's some real benefits there, right? As opposed to Florida, that is a judicial foreclosure state, which is benefits to that. But the other side is that you have a lengthy litigation, and you can actually evict people in Florida very quickly relative to, like, say, for New York, right? Like New York, for example, getting a tenant out in New York as a renter is very, very, very challenging. In Florida, you post a 3-day notice, they don't put the money up in 30 days, you have a hearing, and they're moving out very quickly. So there are nuances to the venues, but those are the kind of things and they're very, very significant for people who are lenders and need to rely on the rule of law to enforce the contract rights.
So, Elena, as I was thinking, what question do I ask you? Somebody asked a question. Victor Russell, can any of the panelists invest in a fund that invests and specializes in buying Texas foreclosures, commercial and residential, willing to get 15 to 20% IRR on their cash? So, will you invest in Texas foreclosures? Why yes? Why not? You can say, I don't have any expertise in Texas foreclosures. I understand Texas foreclosures, you got two guys with hats that show up with guns and then foreclose. No? Is that a Texas foreclosure? But is that of your interest? What sort of IRR hurdles are you looking for when you have a foreclosure fund? And also, have you guys adjusted the IRRs from 2019 to 2020 to 2021?
On private debt, we are looking, if we talk about Western Europe, then we're looking for double-digit return. When we invest and go for senior secured private debt, then we can achieve from 10% to 14%. But when it's 14%, it is closer to distress, like Rafael likes. And if we go to Asia, it's possible to find opportunity in private debt, in oil and gas industry, in transportation industry, even for 18% interest rate. It's not IRR, it's interest rate. And if we go for private equity, we're looking for funds which can bring us 30 to 33% IRR, this range.
Thank you. Camilo?
Sounds good, right?
Yep. Camilo?
We didn't adjust the IRRs. We didn't adjust the rates. We did adjust the risk parameters. Actually, when this happened, we reduced a little bit the LTV, and we start getting 12 months reserve in interest to reduce the risk and reduce the dependence on the cash flow of the property or the borrower, because we didn't know at that moment how long this will last. It's lasting longer than expected, I think, at least for us. But we didn't increase the interest rate. We rather decreased the risk, which for us, I think, is better, and for our investors is easier to not get a higher return, but keep getting the cash flow and not getting a huge amount of foreclosures or something like that.
So Rob, you're more in the residential fix and flip side. Can you tell us more about underwriting the property versus underwriting the person? I mean, what is more important for you, loan to value or character?
I would agree with Ralph that, it's all about price. They both matter. They both matter significantly. But at the end of the day, we're looking at the property. We are a hard money lender. A bank is a cash flow lender, so they're going to look at those sorts of things. It gets interesting in the underwriting for sure. We're looking at the property, what we can do with it. Another point Ralph made before is velocity matters. We're not interested in the Zoom towns and those sorts of things. Because when the party stops, and it will, you're going to be left with a bunch of stuff in tertiary markets, and there's going to be no buyers. Mm-hmm. So, and I think that's going to be a problem for us.
Well, I think that this time might be different. And my perspective is that when we started in 2009, there was nobody to catch that falling knife, which was the single family asset class, right? It just kept on dropping and dropping and dropping. I remember when I bought my first single family, I had a call from the broker, said, we just noticed you bought one, can you buy 10 more, right? And for the first 4 years, I will say until 2012, it was just basically a lack of liquidity. I personally believe that this time around is different because you got the single family asset class already established. And you have a lot of the funds jumping into the market, even in secondary and tertiary markets. So I don't think that there's going to be that huge of a drop. Are you feeling more comfortable with the residential sort of multifamily premise that people will pay rent no matter what? And I mean, what we saw from COVID, is just a clear adjustment of, it wasn't that bad. I can lend a little bit more here as long as it's supported by the cash flow. I have a saying that the cow is worth the milk it gives. And if it's not, it's a pet, and we know pets are expensive. So the question to you guys is, are you feeling more aggressive towards the residential asset class than the other commercial asset classes? And if so, what do you think is going to happen with the rest of the market and the banks with that? Because the banks are being kind of like, still a little bit on the side.
Yeah, I'll jump in. I think it's really interesting. One of the, elephants in the room or whatever is the fact that we are underbuilt. We are significantly underbuilt. And if you're talking about a hangover effect, from 2008, we just quit building everything. And so we are under. And if you split the market into low end and high end, the low end off the 2011 lows has recovered by about 60%. The high end has only recovered about 30%. And the high end is starting to come back up. Now, high end has some issues with it, the mortgage deductibility cap and all of those sorts of things. But it's, the low end has come. So now what we're starting to see is a rebalancing. So you're seeing absolutely there's demand at the low end into multifamily and those sorts of things. And then multifamily wants to move out and move up. So they move into single family residential, and so we've seen the price pressure there. What we haven't seen is I'm going to sell my starter home and I'm going to buy the next home. There's not been a lot of liquidity up at the upper end. And so we're starting to see that spread out. We're also seeing spread out into tertiary market. I can't afford where I want to live. I'm moving into tertiary markets, those sorts of things. And I'm not trying to defend that position. I'm just saying it's a pretty normal cycle at this point. The abnormality has been the extended or the big pop in low end prices. And that's probably significantly, there's the COVID impacts and those sorts of things, but we're also feeling the effects of underinvestment in that for an extended period of time.
Camilo,
Yes,
you are a lender and also you co-invest with developers. How important is replacement cost theory for you? I mean, I've seen people right now buy multifamilies at 20, 30% above what the replacement cost is, or people lend on homes above replacement cost. Are you guys keeping track of that?
Yes, and for us, it's still one of the most important and fundamental analysis, the replacement cost. And in multifamily, because it's about demographics, having people that is going to rent from you, but also what is coming to the market. And if you can develop a product that is below replacement cost to what a new product will be, which will be your competition down the road, that I think that makes a safer investment. And we do the same for loans. We do the appraisal, the third-party appraisal, etc. But we focus on analyzing what will be the replacement cost for a property. And if we are well below replacement cost with our loan to value, that makes us a pretty safe loan for us. And also, I would like to say something about your previous question. What is more important, the value of the property or the character? We are bridge lenders and asset-based lenders. So we tend to focus on the property value. But our experience, and mainly the last 2 years, and it was reinforced last year, is that every time that we have a problem, it's not because of the property, it's because of the character of the borrower. So even though we don't want to be like banks that take 6 months to decide if they want to do the loan or not, because they keep asking questions and information about the person, we do want to understand and know the sponsor, their experience, their ideas, what their nature, and if we can trust them and develop a relationship, that's why we focus on trying to do repeat deals and be flexible with the people that we already like. We do the loan based on the LTV, but for us, it's becoming more and more important, liking and understanding the experience of the sponsor, and that we can feel comfortable with him, because we see this as a partnership. Even though it's a loan, it's a partnership.
I personally think that character is undervalued. And it's equally important on the investor side than on the borrower side, right? I mean, we do AML, KYC, and everything to our investors, to all of them, people that I know, to my family, right? And also to our borrowers. We just don't want to be lending money to people who are in the FBI most wanted list, right?
But not only legally, but also morally, that you like correct. Them, that you feel okay, and that you want to have a lunch with them and you enjoy your time and you can talk about the business and something different, not only the transaction.
And I'll just add to that, if I may, that we look at character. Now, listen, clearly we're already buying an asset, and so the character's in place, but that's part of our underwriting. And the one thing that you cannot underwrite is fraud, right? And that means the fraud of an individual, the intent, right? There's no way to truly underwrite that. Yeah. And so the only thing you can do is price in a premium. And ultimately, listen, at any one time I'm managing, we're running somewhere between, 50 litigations and up. We also do litigation funding, by the way. But so that's part of that. But the point being that where we seem to always run into a roadblock or rather a hurdle is a better way of saying it, is from the character side. Because when you see people that have a character that character issues, they the ones that are prone to creating the problems. I think, as you said, Camilo, you don't run into issues with the LTV. You run into issues with the borrower ultimately, right? And I think that I would concur with that. And I say, again, it's very, very difficult to underwrite fraud. It's impossible. All you can do is price in a premium for that risk.
Yeah, one shortcut there though, and I totally agree. If they want to perpetrate it, you want to try to make sure that you're not it, but it happens. But one of our real shortcuts is whether they'll get on the phone with us. So not only on the back end, right? Things start going bad, and you miss a payment, ACH bounces, whatever. We'll call them up and just if they start not answering their phone, we're going to go straight into forbearance, foreclosure. Whereas if they get on the phone and they go, oh yeah, something bad happened, you've got a path to resolution. And early on, so that's on the downstream. On the upstream, you can do it too. And we do it frequently with our loan docs. We'll call up and say, hey, Danny, thanks for interest in a loan, but we're having a problem finding your bank statements. We're having a problem with title here, whatever. How do they react? Do they jump on the phone? Do they engage with it? Do they try to push it off on somebody else? And you're getting an early look. You're getting an early window into how they're going to react if it does not go right.
Well, my personal experience after having to deal with 800 single family and small multifamily, I always, I was the one who basically signed the eviction process. And I always ask my property managers, when you call them, do they pick up the phone? Do they actually care? And the answer is, oh yeah, we're talking and so forth and so on. Then you tend to have more of a lenient attitude, right? Somebody just basically doesn't pick up the phone and it's not there. It's just basically nothing you can do about it, right? So I totally agree. I mean, it's a question of you underwrite a loan, and it's a character issue. I think we're running out of time. Michael, how many minutes do we have?
A couple more minutes.
Can I squeeze one last question?
Yes, that would be good.
Okay. Technology. How are you using technology to your advantage, right? And how has it that impact your business over the last year? And by the way, Zoom is not an answer. Elena, please.
Honestly, I don't even know. It's a little bit difficult to do due deal on an asset through a phone or through Zoom, but yeah, it helps. Also, we do it through WhatsApp. My WhatsApp became such a good asset for business. No friends anymore, no family, just business contacts on WhatsApp and Telegram. So actually, yeah, this new normality, we cannot fly to some region to look at the asset, and we need to rely on video on our partners there who can do due diligence instead of us and show us the property or an asset. So that's how it works. Yeah.
Awesome. Camilo.
Yes, we've been doing a couple of changes and improvements to facilitate and make the business as digital as possible. So in the lending side, we are finishing the development of our new webpage, which will allow brokers and borrowers to monitorize the whole application process of their loan, like a workflow, digital version of the workflow, and they can upload all the information. I know the big banks and the big firms, they have that, but we didn't have it. So now we are trying to expedite the application process for new loans. We are developing our own app for our investors and partners, co-investors and partners, where they can get access to their new opportunities, their statements, everything digital to make them easy. And I think that those are the main changes that we've been doing. We try to run everything through softwares and through interface. We've been trying to reduce as much as possible the manual input, only to one manual input that we can audit pretty well. And then everything should be through interfaces, through the systems. Those are basically the changes that we've been doing or implementing.
Rob.
Yep, we are big trust and verify guys. So on the development on the properties, as far as they're going, we are definitely getting more pictures and those sorts of things. We're still doing the drive-bys. We are using Uber drivers, and we have taught a group of Uber drivers how to go take pictures of homes. So when the borrower says, you know, this is what's going, I'm working on the plumbing or whatever, we get the Uber driver to drive through. That's $50 a pop. It's been great. And then we're definitely trying to clean up the friction, because frequently, you know, the verification process gets pushed onto the borrower, and we don't want to do that. So we're clean, the investor side, clearly we're cleaning up, but on the borrower side, we are making it easier for them to interface, much more of a one, two, three. If I could show you my whiteboard, you could see the restack of the technology that we're doing there.
Rafael?
On our diligence side, everything is automated, as well as I think I like the, you know, trust and verify. Definitely. We have everything that's really automated on our side. Everything pulled and extracted from records and comparative analysis is, and then all verified internally. And then we do drive-bys as well on the diligence side, because we are a registered investment advisor, and, you know, obviously under SEC regulatory and whatnot, all of our back office and our compliance and all of our admin, everything is highly complex and automated for reporting and compliance purposes. So technology is a big part of what we do, without a doubt. And we're always, you know, we have a robust platform, and it's, again, partially because we're mandated to do so by the SEC as being a registered investment advisor. And then, of course, you know, for our operations, clearly all of the diligence and everything that we do. So definitely.
Okay, I think that's as much time as we have. Camilo, Elena, Rob, Rafael, thank you very much for being such a great panel. For the close to 150 people that we had here, thank you very much for your time. Michael and Jeremy and your team, thank you for putting this together. And again, for those people who are in the first lines and helping the hospitals and the first responders, thank you for being there for us.
Thank you, everybody. Nice to see you.
Thank you.
Danny, Rob, Camilo, Rafael, and Elena, thank you for your time today. Thank you for participation in our group. It was an excellent panel. Danny, you did a great job. Thank you.
Thank you. I'm gonna put my contact information on the chat for everyone to contact me. I put in the Futurology website if you guys want to read about the impact of technology in real estate. And, you know, I guess you guys are all our names and numbers. You can link us in and be our friends. Thank you. Bye.
Thank you very much.
Thank you.
Bye.
All right. Thank you all. Thank you all very much.